Good evening, everyone. Time for another silver update. This is the 1 hour chart of silver provided by netdania.com. You can click on the link below. I've drawn in a primary flat trend channel that we're in right now, and I've also drawn a descending trend line here that seems to be forming up. So we're right about in the middle of this trend channel, and it goes all the way back to mid-January or so. Now, as you know, we're up about 20+% for the year. That's partly because silver was fairly well smacked down at the end of the year, so that's kind of a reflex response. But still, silver is by far as my knowledge goes, the best performing asset of the year still at these prices. So we're looking for a test of this descending trend line. We're also looking for a test of this sideways trend channel. If you'll note, the volume has been decreasing. We did get a little bit of volume here, but nothing like the tremendous volume we had during the smackdown period. So, as I pointed out before, silver tends to rise on low volume and then decline on very, very heavy volume. And so we're looking to see if we begin to rise as the volume begins to fall off again. Now, I wanted to go to the main story tonight. I'm going to tie a few things together, but if we go out and take a long-term look at silver, perhaps the daily will do. Yeah, the daily should do. We do have kind of this falling trend channel, very large trend channel. It's not quite parallel, but something like that. And it seems to be coming out of that, but this is kind of based upon the idea that well, let's pull out to the weekly actually, that we have the idea that silver is a reflection of the economic fundamentals, and that because its primary use, and we're going to see that when we look at the GFMS survey, its primary use is the industrials, which has replaced photographic and jewelry and everything else. But the general consensus with silver is that when the economy slows down, silver is going to fall in price because of that large industrial component factor. Whereas gold, if you remember back, we'll pull up the gold chart. If you remember back in the 2008 financial crisis, gold really didn't, it corrected, but it really didn't correct nearly to the extent that silver did. You can see that this support here pretty much held with gold. So the general consensus is that the reason why silver falls drastically when there's a whiff of deflation or some hint of negative financial news is that it's so sensitive economically. Now, I'm going to try to challenge that, but before I do that, I want to jump to one of the main articles I want to cover, and that is one that was covered on Zero Hedge recently, and it's from Gains Payne's Capital. And this is a series of charts that are pulled from the Federal Reserve's own site. And this is titled 5 Charts That Prove We're in a Depression and that the Federal Reserve and Washington are wasting money. I'll read a little bit, and I'm just mainly going to go over the charts. Wall Street and mainstream economists are abuzz with chatter that we're seeing a recovery in the U.S. due to the latest jobs data. These folks are not only missing the big picture, they're not even reading the fine print. More on that in a moment. The reality is that what's happening in the U.S. today is not a cyclical recession, but a 1 in 100 year secular economic shift. See for yourself. Here's the duration of unemployment. Official recessions are marked with gray columns, while the chart only goes back to 1967. I want to note that we're in fact at an all-time high with your average unemployed person needing more than 40 weeks to find work. Here's the labor participation rate, and so he goes through these Now I wanted to show you these charts and look at them in a little bit of detail. This first chart here, the average mean duration of unemployment, this is one of those that is really a shocking chart, and you'll note that it pretty much did decline after every recession. The dark bar area is the recession. You can see that the Clinton recession, that was the one that we had a lot of people questioning whether the recovery actually occurred. It really wasn't until 95 and the beginning of the dot-com explosion that we actually did get a recovery. And you can see that this mean duration decreased. The same thing after the Bush mini recession. But you can see a dramatic pattern shift here that after the recession, quote unquote, ended, and you had that here a little bit and here a little bit, but drastically here, that the mean time is just rising and rising. But again, that's just kind of a anecdotal sort of statistic. It's really not hard statistical science, what I would call. So this one is much more so, much more important. This is the civilian participation rate. This is really not something they can lie about. This is just the percentage of people in the population who are participating in the labor force. So you're talking about not taking out your retirees, you're talking about taking out your welfare recipients, you're talking about taking out your unemployed, and you can see that it's a pretty steady fall all the way from about 1999, and it continues to fall. So this figure is going to impact another figure that we're going to look at down below, which is the gross tax revenues, which you would expect to fall due to the fact that less people are working. So now that doesn't necessarily have to be the case. If less people were working at higher wages, then they could actually have higher revenues. But as you'll see, that's not the case. Now this is industrial production, and you can see that it's nearly recovered to pre-recessionary levels. Unfortunately, we're coming close to another recession. Now, the 2000 one was took a little bit of time to recover. You can see that all the previous ones, even the drastic double dip recession of 1980, the early Reagan years, it pretty much came back fairly quickly within a year or so. So, and of course the Clinton recovery, it rapidly recovered. But as you can see, we're standing right now below pre-recessionary levels, and we're technically almost 3 years past the official end of the recession. So very problematic statistic for industrial production. And the real deal breaker here ultimately is going to be this U.S. federal tax receipts by year, because this is going to be the number, the dollars, the raw dollars that the IRS takes in as tax revenues. And this is really going to be the one that tells you what's going on. Now, you can see we were at a high in the years of 2006, 2007, 2008. We'll just give an average of about $2.5 trillion. You can see we've fallen to about 2.2 and pretty much have flatlined at about 2.2 trillion in the last 3 years. So we're stuck here below those old highs, but even more startling is the fact that we're really just a very small amount above the tax revenues that we took in the years 2000 and 2001. So I wanted to take you over to a chart. Well, it's not a chart, but it's just a listing here. I've got separate Wikipedia entries for these, but it's too much work to go through each one of them. So I found one on the Democratic Underground that gives a listing of these budget submissions, and you can see the period that we were looking at there, the 2000 and 2001. You could see that Clinton submitted a budget of about 1.8 trillion and 1.9 trillion for those years when we had 2+ trillion in tax revenues, very close to what we have now. But you can see under the Obama budget, we're looking at 3.7 here, and that's the 2012 projection, but I think it's going to be higher than that. So the 2011 is 3.8 trillion. That is a good 2+ times the amount of money spent that we spent back in 2000. And so we're spending more than twice as much money. The federal government is spending more than twice as much money, and yet they're barely taking in more revenues, tax revenues. So we seem to have hit a wall here, and it's not really surprising for any of you that are von Mises economist types that eventually you're going to reach a point where if you tax enough and spend enough, the government, which is a unproductive organization, if you reach a certain point, then it's going to become negative, and that we're clearly at or beyond that point. So that's going to take me to the main article, and the reason why I'm talking about these things is that I want to talk about silver, because that's the thing I want to link this to. Now, this PDF here is from the Silver Institute. I'll go ahead and link that. And there's a lot of charts, a lot of interesting information. This is for 2011, and this is future industrial demand for silver provided by the Silver Institute. And what's so interesting about this, when you really get in and examine the numbers, is that this really gives lie to the idea that they talk about of how silver is such a industrial metal and controlled by the projections for economic growth. So you can see when we look at this left-hand chart here, we're looking at industrial share of total silver fabrication. Now, one thing that's really striking is that you can see this number is above 800 million ounces, and I don't even think we pulled that much out of the ground. It's a tricky figure to figure out because they have a recycle figure, and the numbers are fishy, but that's a very, very high number. Now you can see that this industrial fabrication has steadily risen, and what I wanted to point out in regards to these economic numbers is that we had one dip here, and that was the year 2009, and then we snapped back, right back up, and you can see on the total that we're nearly to the total highest we've ever been. You can see on when they just take a breakout of just the industrial fabrication, you can see we just had that dip and we came right back up. Now there's some other charts on here that give a more detailed view, and that's going to be brazing alloys. It gets very deep into the uses of silver. I highly recommend this article. There's one chart here that gives us an overlay. Oh, I'm sorry, that was this chart here. So you can see this overlay of industrial production. That was the statistic we were looking at with those other Federal Reserve statistics. You can see that industrial production is actually below the 2000 peak. Okay, so we are not recovering. Now remember, this industrial production is going to be, my guess is this is a U.S. figure. I might be wrong on that. It might be, the source is the GFMS and the IMF, so it might be an international figure. But you can see that industrial production has not recovered from the 2008 peak. But you can see that silver industrial demand has definitely returned, and they're projecting, I don't have that here, but they're projecting it to go much, much higher. So what's the bottom line of all this? I think the bottom line is this, that the United States is in some type of secular decline, and one of the ways they play their manipulation games with the silver is that they smack it down when they have negative economic news to report. But I think if you look at all these charts and add them all together, you're going to find out that the United States is pretty much going to be left in the dust as far as this silver story goes. And the only way you can account for silver snapping back so rapidly while all of the other numbers the United States is reporting continue to decline and actually show depressionary levels is that the demand and use for silver in the East, in Asia, in India, and the rest of the world continues to grow, even though the United States declines. And so ultimately, I think that's going to indicate that the manipulation in the United States is going to have to end, that the use of cell phones and computers is going to grow over the next 100 years, as Jimmy Rogers has pointed out, and that the East and Asia is going to continue to rise. Ultimately, that's going to cause a price explosion in silver, and hopefully you're going to be there for the ride, and we'll talk to you next time.